Stochastic Rsi. The next indicator we'll be talking about is called the Stochastic Rsi, and the Stochastic Rsi is actually fairly intuitively, from the name, you can probably guess what it means. It's actually just a combination of the stochastic oscillator and the relative strength index. Alright? It also serves the same functions. So the Stochastic Rsi is an indicator that lies between 0 and 1 and tells us the level of the RSI indicator relative to its high and low over a specified period. Now, if we think back to what the stochastic oscillator does, it looks at the price relative to its highs and lows over a specific period. With the Stochastic Rsi, what we're going to do is, instead of looking at the price over its high and low, we're going to be looking at the RSI over its high and low. So we'll be looking at what was the RSI over a particular period, and it's the highs and lows of the RSI. So it's actually looking at the momentum of the RSI rather than the momentum of the price. So the calculation is actually the same as the normal one we use for the fast stochastic, right? So with the fast stochastic, we just use the same calculation. Instead of using the price, we're just going to use the RSI, okay? And like with the RSI and with the stochastic oscillator, the stochastic RSI is designed to identify overbought and oversold conditions. So let me talk about probably the more common trading strategy with the Stochastic Rsi. So as you said, it does lie between 0 and 1. It can be converted into a percent, so it could be 0 and 100%. There would be no reason we could not do that. But in practice, I guess most people tend to look at it between 0 and 1. So when the Stochastic Rsi is below 0.2, that indicates that the asset is oversold, and that's a buy signal. Conversely, when the stochastic oscillator is above 0.8, that indicates that the asset is overbought, and that would be a sell signal. So this trading strategy is really very, very similar to what we do with the RSI and what we do with the stochastic oscillator itself. So in that sense, it's really nothing new. We're just kind of combining two different indicators that are really designed to do the same thing. So the stochastic oscillator and the RSI are both designed to find overbought and oversold conditions. So then someone had a bright idea to combine the two and see if maybe that would actually do a better job of finding the overbought and oversold conditions as opposed to either of those two indicators on its own. So we'll now go into Excel and we'll show you how to calculate the stochastic RSI. It will involve first calculating the RSI and then calculating the fast stochastic of that RSI, so it may be slightly computationally intensive, but nothing that is too complicated to understand. So let's now head to Excel. Stochastic Rsi. So now what we are going to do is we are going to calculate the stochastic RSI, and first we need to calculate the RSI, and then we essentially apply the stochastic oscillator to the RSI. Now we're going to follow a couple of steps. So the first step we want to do is calculate the RSI itself. So let me first go ahead and do that. Now, if you remember, we did the RSI in the previous lecture. So I'll just go through it fairly quickly and I'll walk you through the calculation again. Just it helps us, the more we do it, the better we get at it. So the RSI first looks at the number of up moves versus the number of down moves. So we have up moves and we have down moves, okay? And we only use closing prices for the RSI. So an up move occurs if the price goes up, and a down move occurs obviously if the price goes down. So the way I would calculate the up move is I would say that if this day was greater than the previous days, that is if the price rose, then I would like this day minus that day, okay? Otherwise, I would like 0. Alright, in that case, because the prices fell, it's a 0. And now with the down days, I'm going to do something a little fairly similar. So I'll say if this day was less than that day, so if the price fell, then I would like this day, that is price at the previous day minus current price, because we need it to be a positive number. Otherwise, I'll have 0. Okay? So every day should either be an up or down day. and they shouldn't really overlap, and that's fine based on what we have here. Okay, that's the first step. The next step is to calculate the relative strength, right? So we take the exponential moving average of the up and down days. So I'm going to have EMA of the up days, and we'll do the 14-day EMA, which is the standard for the RSI, and then I'll have the EMA for the down days at 14 as well. So hopefully you remember how to calculate EMAs, because we did a lot of that. So let me just copy these two values across. That's 2115 and that 0, just to make it easier. And let's just put this in a nice format. So how does the EMA work? Well, if we remember, the EMA is equal to the current value, okay, minus the previous day's EMA, which for the first observation we just have to use the price itself. Alright, that's the first thing. Then we multiply it by 2 divided by n plus 1. So in that case it'll be 14 plus 1. And then we add on the previous day's EMA. Okay, so I copy this all the way up. That gives me the EMA of the up moves. And then the same calculation for the down. So let's just make sure this is all okay. And that's fine, because it's using the next value across. And then I copy this all the way up. Now I have the EMA of the down moves and the EMA of the up moves. The next step is to calculate the relative strength. So that will be RS. The relative strength is just the EMA of the up moves divided by the EMA of the down moves. Alright. And the final step is to calculate the RSI itself, which is going to be equal to 100 minus 100 divided by 1 plus RS, which is that. And this is my RSI indicator. Okay? Again, this we did last time. It took a little while, but that's okay. Now what we're going to do is calculate the stochastic RSI. So I'm actually going to use the slow stochastic, because actually with the RSI it's often more common to use the slow stochastic rather than the faster one. The other main difference between calculating it now versus when we did it earlier, when we calculated it using the price, is that we don't have high and low for the RSI. We just have the value of the RSI 1 per day. So we just have to use this value of the RSI. We don't have an open, high, low, and close like we did with the index itself. So we're going to have to use the minimum and maximum of the RSI itself, right? We don't have highs and lows, but that's fine. So let's go ahead and do that. So to calculate the stochastic, I'm going to have my percentage K line and my percentage D line, just like we did before. My percentage K line will be equal to the current RSI, alright, minus the minimum of the RSI, and I'm going to do it for 15 days, which is the standard for the slow stochastic, not 14. So that will be from 2 until 16. Okay, divided by the maximum from K2 to K16 minus the minimum of those values. Alright, same calculation that we've always done for the just like we did for the slow stochastic. And now this gives me my percentage D line. Alright, and this is a value that goes between 0 and 1. Alright, so as we said, it's often used as that overbought, oversold indicator. And then I can also just calculate the percentage D line, which I'll do as a 5-day simple moving average of the percentage K line. Okay, and that becomes my percentage K line and percentage D line. And this is the calculation of the stochastic RSI. So as you can see, it's not too complicated. We have to calculate the RSI first, which takes a little bit of time. But then following on from that, we just calculate the stochastic as normal. Now you can also do it with the fast stochastic, so you can do it with either the slow or fast. Oftentimes it's better to do it with the slow, because the RSI, we don't even have open, high, low, and close, so we may have too many extreme values if we just use the fast stochastic. We even have a lot of zeros and ones, so you have zeros here, for example, you have a 1 here. Whereas with the stochastics, you don't have that because it's looking at the highs and lows rather than the closes. So again, you can use this as a trading strategy whereby we buy, for example, when the percentage K line is below 0.2, sell if it's above 0.8. That's one trading strategy. Other trading strategies, sometimes people look at to confirm trends, and they use it in combination with this fast and slow stochastic, or they may use it in combination with the RSI itself. So there are a variety of things we can do with it. We won't really go into too much detail at this time about what else we can do with this indicator. So again, when we go through trading strategy and technical trading systems in the next module, then we'll really get down and dirty and look at, well, how do we optimize these indicators? How do we make sure they're performing well? Which one works well? Which one does not work well? So that's what we're going to do later on. But the purpose of this is obviously for you to understand how to calculate the indicator. So it's really important that you can come away and you can be able to replicate what we've done so far in Excel and be able to calculate all of these indicators on your own. Okay, so now let's go on. We're going to now talk about the next indicator, which is the Williams percentage R.